Today, we're jumping right into what might be one of the most polarizing questions we've seen in the analysis reports lately.
It really is.
Is supermicrocomputer, SMCI, the single most undervalued AI infrastructure stock you can buy right now?
It's a huge claim, but the reports we've analyzed, they paint this picture of a massive discrepancy. The stock's been, well, let's just say volatile.
Yeah, putting it mildly, trading around, what, $29, $30? And yet, Wall Street's consensus has just been remarkably steady. And that's really the core of our deep dive today. We've got a stack of analysis here, all pointing to a collective 12-month price target of $48.53.
Which is a 63% upside from where we are now?
Exactly. So our mission is to figure out how these experts are projecting such a huge gain, potentially anchored all the way out to 2026, when the market just seems determined to punish the stock.
Right.
We're going to unpack the valuation case and maybe more importantly, the hidden tech catalysts that are driving this whole thing.
Okay, so let's start with that valuation case, because that's where the opportunity is fundamentally defined. The bull case, it starts with a pretty startling idea.
Which is?
That SMCI is currently priced as if it's, a legacy hardware company, like its growth has completely flatlined.
Priced as if it will never grow again.
Never grow again, exactly, which is just, it sounds crazy when you say it out loud.
It does. I mean, this is the company that's right at the heart of this massive global AI build-out. They're building the literal server racks that hold the NVIDIA chips everyone wants.
And the numbers, they just bear that disconnect out so clearly. If you just look at the standard metrics, it's obvious.
Like price to earnings, for example, the PE ratio.
The PE is sitting at roughly 24 times. Now, on its own, 24x is fine. But for an AI infrastructure company, one that's still projecting double-digit growth.
A company whose problem is supply, not demand.
Precisely. That valuation is just, historically, it's incredibly low. We're talking about an industry where other players are getting multiples 2, even 3 times that.
And the PE can get a little muddy sometimes, with earnings adjustments. I think the metric that really just screams undervalued here, based on this analysis, is price to sales.
Oh, absolutely. That's the most telling metric of all.
The PS ratio.
It has fallen below 1. It's hovering around 0.91 at the current price.
Okay, so let's translate that for you, the listener. What does that actually mean?
It means you are paying 91 cents for every single dollar of annual revenue that the company generates.
Just think about that for a second. When a company trades below one-time sales, the market is basically saying it has zero confidence in future growth.
Zero. It's valuing the company at or near, liquidation value.
And then you contrast that with the rest of the industry.
Exactly. You look at the other AI darlings, the other hardware and platform companies, they're trading at 10, 15, sometimes 20 times sales. SMCI is under 1.
It's an unequivocal signal then. The market is just over-indexing on past drama, maybe those accounting headlines that spooked everyone.
They're pricing in the bear case and then some. It's all fear.
So if the market is so focused on that short-term noise, that brings us to the next logical question. Why hasn't the analyst community panicked?
Right. Why are they holding the line with that 63% upside target?
This is really section 2 of the bull case, isn't it? The analysts are looking right past all that quarterly noise.
They are. They're focusing on the core business function. And despite all the turbulence, the professional analyst community has not backed down.
Nope. The analysis confirms it. That average 12-month target, it's anchored at $48.53. And this isn't some 5-year projection.
This is a potential 63% return over the next 12 months. That's what the consensus is telling us.
And it's deep-seated confidence. We see firms like Needham, Argus, they're maintaining targets way higher than that. Some are even pushing towards $60.
So what's fascinating is why? Why haven't they capitulated and lowered their targets like you'd expect with all this negative sentiment?
They must be seeing something that the everyday investor, the person just watching the chart, is missing. What's the fundamental reasoning?
It all comes down to the steady, essential nature of what they sell.
The plumbing.
It's the plumbing and infrastructure for every modern data center. The demand for AI, for the servers they build, that hasn't gone anywhere.
So the business fundamentals are intact.
Totally intact. The reports all emphasize that the sales pipeline, the key relationship with NVIDIA, their ability to create custom solutions, all of that is still there.
So the analysts are basically saying the stock price is just disconnected from the operational reality of the company.
Exactly. But, fundamentals alone don't move a stock overnight. The market needs a catalyst, a big one, to shake off this fear.
Okay, so what is it? What's the technological engine that's supposed to drive this next growth cycle?
The analysis points to one thing, and one thing only. It's the arrival of NVIDIA's next-generation superchip, Blackwell.
The year of Blackwell. I've seen that term in these reports.
It's absolutely central to the whole bull case for SMCI.
Blackwell is a huge leap in power. We know that. But what does that actually mean for a company like Supermicro, the guys building the boxes?
It means a crisis in thermodynamics, basically.
Heat.
A whole lot of heat. The jump in computing power that Blackwell brings is incredible, but it comes at a severe cost.
Yeah.
These chips run intensely hot, and traditional air cooling, it just can't handle it anymore.
It's like trying to run a supercomputer in a hot closet. Eventually, it just shuts down.
That's a perfect analogy. And in a data center, the financial stakes of that shutdown are, orders of magnitude greater.
And this is where SMCI's long-term strategy really starts to pay off. This becomes a real, tangible advantage.
Precisely. This is the key. Supermicro has been perfecting integrated liquid cooling for longer than almost anyone else. They weren't waiting for this problem. They were building the solution for it years ago.
So they're ready to go day one with racks that can handle Blackwell.
Exactly. And it's not some niche product for them. It's become an essential, non-negotiable requirement for the next generation of AI. They're perfectly positioned to solve the physical problem that the world's most powerful chip has just created.
Okay, so that's the critical link, that technological edge. That's what directly translates into these aggressive revenue projections we keep seeing.
It absolutely does. This is the anchor for the whole financial forecast. We're seeing revenue projections for fiscal 2026 that are still upwards of $36 billion.
$36 billion.
Largely driven by these specialized, high-margin, liquid-cooled server solutions.
Okay, so let's just make that crystal clear for you listening. If Supermicro actually hits that $36 billion number, driven by this absolute necessity for liquid cooling,
then the stock price simply cannot stay at $30. It's logically impossible.
if the revenue doubles or triples, the stock price has to adjust. It has to close that massive valuation gap. The business growth will literally force the stock price to follow.
The market might be trading on fear now, but the tech shift and the revenue growth, they paint a completely different picture. That cooling advantage is the mechanism that gets them to $36 billion.
And that makes the current stock price, the current discount, totally unsustainable.
Exactly.
All right. We have screamingly cheap fundamentals. We have a massive technological catalyst on the horizon. Now let's tie it all together and look at the technicals, the chart.
Right, because the question isn't just if it will recover, but, when and how fast.
So what does the chart setup tell us? Is the market getting ready for this shift?
The technical analysis in these reports is actually very optimistic about the immediate term. If you look at the price action, you can see the clear formation of a rounding bottom.
Right, at that $29 to $30 level.
Exactly. And for anyone who's not familiar, a rounding bottom is a classic pattern. It basically signals that a sharp, panicked selling trend has run out of steam.
It's a shift from selling to accumulation.
Yes, slow, sustained accumulation. It suggests that the institutional money, the big money, is quietly building a position down here.
And that's reinforced by the support structure below, right? The stock just has not wanted to break those lows from earlier in the year.
It has fiercely refused to break below that 25, 26 SI level. That establishes a really solid floor for the price.
So we've been consolidating for a while. It's this battle between buyers and sellers. What's the specific technical hurdle that the analysts have identified, the trigger that starts the run-up?
The magic number is $35.
$35.
If SMCI can break decisively above $35, especially on strong volume, the reports say it is expected to trigger a very significant, very rapid technical breakout.
And once you hit a predefined trigger like that on a stock everyone's watching, you bring in the algorithms.
That's the key. That move above $35 is expected to trigger large-scale algorithmic buying. It'll wash out the shorts. And that momentum, combined with the fundamental pressure to, close that valuation gap,
Could send it flying right towards that $48 consensus target.
very quickly. You have strong fundamentals, a critical catalyst, and a clear technical trigger. It's a powerful combination.
This analysis really gives us a complete framework then.
Yeah.
It goes all the way from the macro market mistake down to a specific price on a chart.
Right. To just summarize what the analysis is telling us. At the current price, around $29, the bear case is already priced in. All the fear, the headlines, it's reflected in that shockingly low price-to-sales ratio.
You're paying for yesterday's news.
You are. The bull case, on the other hand, it relies on a technological certainty, the absolute need for liquid cooling for Blackwell, which supports a clear revenue path to $36 billion by 2026.
Offering a potential 63% return just to hit the current consensus target.
And this analysis really frames this moment as maybe the most significant buy-the-dip opportunity for high-growth AI exposure looking out to 2026.
Okay, so that leaves you with a final provocative thought to really mull over.
We've established that the reports show other AI companies trading at 10 to 20 times sales, while SMCI is below 1.
Right.
So if that $36 billion revenue forecast holds true and that $35 technical breakout actually happens, the market will have to start normalizing that valuation.
It has to.
So think about this. What if the stock merely managed to close that PS gap to just 5x sales, still a massive discount to its peers?
Still a huge discount.
What kind of acceleration would be required to push the stock not just to that 48-order target, but rapidly past it? In that scenario, 48 orders might just be the very first stop on a much, much longer journey.
That potential for a rapid re-rating. That is definitely something worth considering. Thank you for joining us on the Deep Dive.